this is Lin and Patrick. Today we are at 4S Ranch in a very beautiful family-oriented home. So if you like this home will be on the market soon. Keep an eye on it.
That's right. It'll be on the market soon, and people are going to be borrowing money. And there was an announcement the Fed is cutting interest rates to virtually zero. Questions on that. Does that mean that mortgage rates are going to go to zero?
The simple answer is no, because the mortgage rates are not directly tied to movements in the federal funds rate. You will see the interest rates reduced on car loans, home equity loans, and credit cards, but it doesn't really directly impact the mortgage rates.
Oh, I see. So what are these mortgage rates tied to?
Actually, the mortgage rates are more closely tied to the movements in the 10-year Treasury yield.
Ah, I see. So in that case, why have mortgage rates not dropped as much as the 10-year Treasury?
Actually, there are two reasons for that. And the first one is very simple. It's the supply and demand. Because everybody knows that with the initial drop with the mortgage rates, because it dropped even lower to 3%, and a few weeks ago, so lenders get a lot of applications. So they have to be able to keep up with the volume. And one way to control the volume is to raise their margins. And when they raise their margin, it means the interest rates the interest rates are increased. The second reason is market driven. When the mortgage rates go up, and then the 10-year Treasury will go up automatically. They are always on the same line. But while these bonds, like when I talk about bonds, it means mortgages and the treasury, they usually move mostly together. But the current situation, everybody knows that the coronavirus driven the market fear, and then make many buyers to buy the safer U.S. 10-year treasury bonds instead of the mortgage bonds. When there are a lot of more buyers than sellers for treasury securities, this drives the price go up, and the risk will go lower. When I talk about the rate, it means the return rate. So it's exactly the same like when you buy a house, right? It still come back to the supply and demand. So while the mortgage rates typically follow the 10-year Treasury, both higher margins from the lenders and the fewer buyers in mortgage bonds, versus too many people are buying 10-year Treasury, have forced the rates to not follow the same pattern.
I see. So it's going that way. And there was also something else in the news yesterday about the new quantitative easing in the amount of $700 billion, down to $200 billion. It's going to be directed toward purchasing mortgage bonds and so forth. What's that all about? What does that mean?
Actually, it's not really 700 billion down to 200 billion. Actually, the quantitative easing is the intervention of the government to help for the situation. It means the government will take the 700 billion of the mortgage loans and then put 200 billion to be directed towards purchase mortgage bonds. So it means the government help purchase this mortgage bonds to help keep the mortgage rate lower.
So there'd be more money for people to borrow from to keep the rates lower, to encourage more home buying and other types of buying. That's good news.
Yes, that's a good news. Actually is good. So actually the great thing about housing is that delaying a decision to purchase due to unforeseen circumstances doesn't really eliminate the need to purchase.
That's right. I like it. There's some of the answers. Keep an eye on the market, keep an eye on the money, and it overall looks like a sunny day coming up.
Yes, and if you like this home, please keep an eye on it. And then we know now it's a very difficult time, and we know the rainbow will come up one day. So please stay at home, be strong, and be safe. See you next time. Bye.
Bye now.